Good morning, everyone. Happy Friday. Welcome back to the last session of the week, and glad to have you here, Dan. Welcome again.
Hello, Fabio. I hope you can hear me well and see me well. I'm very happy to be here on this last day of the trading week.
How was your week, Dan?
Was good. Was busy. I didn't have that many trades as you saw. Tried to share a lot of earnings trades. We were luckily successful. Let's see how we finish the week. We will know in 28 minutes how everything went. So, yeah. We got some very nice topic, and we're going to make it a bit shorter today, guys. It's Friday, and there are so many other things going on, and we're going to keep it short, but to the point. And hopefully, you can enjoy this short lesson today.
Absolutely. Yeah, and if you guys have any questions, as always, send us a message in the chat. We'll answer live if we can. And yeah, Dan, take it away. Let us know what you are going to cover today, and how we can look at the data to maybe build some option strategies.
Yes. What are we going to look in today is mainly I wanted to talk about a bit basically we're not talking about earnings. We're talking about regular options trading. Everyone who has been following me a bit and everything I stand for knows that I love trading beta burn, and I love trading volatility. So one strategy is all these many strategies we can do. We will cover at some point. One of my most favorite ones is the short strangle. It's a strategy maybe not for a faint heart if you just start off, but because we were talking a lot about risk, and because MenthorQ is all about data, is all about levels, this is a nice strategy you can really implement, understanding the options, how options are priced. The options squeaks a bit, but we want to make your life easier. And for someone who's been trading with other metrics for a long time and finding MenthorQ and all the data it offers, it gave me more insights into that, and really elevated even this quite successful little venture, I would say. So today I want to talk shortly about short strangles, and we will cover what is a short strangle and of what does it consist. We will take a look how it could work out. I've picked out a stock which fills some of the metrics we like, and we will see how you can use MenthorQ data to set up a proper trade and to see if this could be a good trade. And on the other hand, we will talk a bit about risk management, and just keep it brief and short. And Fabio, if you've got any questions or anything you want to add, let me know.
Absolutely. I think it's great.
Okay, wonderful. So let's do it, guys. I chose United Steel Corporation not because it's a company which has been dealing with different aspects. It's a company which has been in the news because there was a planned takeover which was declined, but it's not final. But this is basically not the aim here. The thing is, yes, we should know about what we get in. I like trading strangles on ETFs a lot because you can manage risk better there, but you get less premium. So I also trade them a lot in equities where I see an edge. And we've been covering a lot of the MenthorQ data and the new dashboard lately. So what are the things which we covered? We covered what we like if we sell credit is that we need volatility to be just very high volatility, like screaming high here. Is it good? If you just look at options pricing, yes, normally it's good. But the thing is, it's also can be basically bad news or something bad is going on. So this could be a warning. But we also have other metrics we're going to look at. Momentum is neutral, which is good, which means we shall a short strangle. And before we deep dive here into the data MenthorQ gives us, we're going to see how a short strangle is built and how it works, so you fully understand the thing. A short strangle lives basically by theta decay and avoiding IV expansion. What do I mean by that? We try to sell high premium. Why is the premium high? Because IV is elevated. And on the other hand, we want to collect theta because we're credit sellers. So let's go in and take a look into option strat. You see, this is just the free one. You can use it at any time, and you can just get it for free. So what things have I chosen here? I've chosen here basically US deal. We will take a look later why I chose that, but let's say we want to trade this company. An option strat, this is basically you can use any other options calculator. This is not better than others. I use a lot of other stuff. I use my broker mainly, but this is very nicely for visualization purposes. We are selling a short put and we're selling a short call. What would be the easiest way to sell two of those ones? Yes, we could sell two at the same strike price. That would be a short straddle. We would buy them, it would be a long straddle, but we want to sell two options, and we're going to sell a put on the one hand, and we're going to sell a call on the other hand. The nice thing is, if you have these two, also is part of margin calculation. If you trade with margin, yes, it requires more margin normally, then you receive credit. In this case, it's a bit different, but normally you can calculate it with the metrics, but this is not part of the lesson today. We don't have that much time. What is the idea here? You see, the idea is we want to capture time premium in the first place. I haven't changed anything in the implied volatility, which is at 88% right now. I've chosen the monthly expiration here. Why did I do that? I'd like to choose monthly expirations because they tend to be more liquid. And yes, you can trade weekly options, but for short strangles, I prefer to do monthly expirations. Especially if we don't trade the big companies or we don't trade liquid ETF. This is the thing. And what I don't trade is shares which don't offer weekly options due to liquidity reasons when I do short strangles, because if something goes wrong, I want to be able to adjust. So if implied volatility stays the same, then just time decay theta burn will just help us if we stay in range and the price doesn't change too much. And this is the thing. We have two strikes here, and we want things to stay in between of these two strikes. You see this nice little tent here. So what can happen to this tent? I'm going to widen this a bit. If implied volatility expands, which we don't want to, you see our profit zone gets lower, a bit smaller. What else can happen? Other things can happen. If the price breaks through a short strike and the premium we collected, we will take a look how things are calculated later. At some point, we here go into the negative zone. A lot of people do the mistake, and that's why I normally like to have things in an Excel and other stuff, not because I'm old school, but I can read options chains and I can do maths on my head. And a lot of people are misled by the expiration time. So if you see that we want to collect the premium a bit earlier, and I will tell you later why, and why then we can look at MenthorQ data, it is important that we don't hold these kind of strategies till the end of the life expectancy. Why is that? Because in the end, we're going to have higher gamma risk. We're going to deep dive in a different lesson into that. But in the end, any small price movement works against us even faster. So the thing is, we will try, if we have roughly 45 days to 50 days, to take this thing off at about 20 days. We go back to our table here. Let's say we do it today. 20 days would be the 29th. So what is the range we have here? So if I widen this a bit, make it a bit smaller. So we have a very nice big range of 15% on the upper and a bit also a bit more on the lower 20%. So this is really, really nice. So we have, the stock has room to move further down and it has less room to move further up. Okay, this is because I chose this strike one, the strikes here. If I choose them more balanced, then they can the same room. This is very nice. So the next question is, we have understood how theta works. We have understood how volatility can work for us or against us, because this is something I've shown various times. We're gonna sell high implied volatility and expect it to drop. What happens here? What happens here, guys? It drops, won't drop that radical. It's not an earnings trade, but let's say it drops 10 points till the middle of it. Isn't that wonderful? We are even faster in the winning zone. And we don't want to capture all the credit. We're going to aim 25% to 50% of this credit. And this can happen very fast sometimes, especially if volatility collapses. So this is the basics of a short strangle. We have two naked options, one put, one call. So let's go back to MenthorQ and see what we see here. We have volatility is high, which is good. Momentum is neutral, which is also good. Doesn't go into one or the other way. Seasonality is negative. So this is something we should factor in. This means if seasonality is negative, this means that we should maybe give ourselves a bit more protection on the downside than on the upper side. We see the expected move, but this is just for one day, but the expected move we will get from the options metrics. And this is basically the point where we start looking at how to choose our short strike. Another nice thing is we see implied volatility is at 80% roughly, and historic volatility is lower. This is already a very nice thing which will help us, because we can expect that volatility will drop by roughly 12% in these time span we have chosen. Isn't that wonderful? An IV rank is higher than 50%. Next to IV rank, I also use IV percentile. This means IV in this condition, which it is in now, is quite elevated, which means this is a very nice, another thing on our checklist to say, this is basically a stock where we can think of selling credit. Yes. What was the most, let me open this. When we looked at the model, which was the most common strategy we chose? It was a simple vertical. We said, if we have the lower band here on the 5-day swing model, we're gonna go here to 36.70 for our break-even point, and we're gonna sell a vertical. Then sometimes, and we looked also how we can set up an iron condor, which is simply basically a short strangle with wings. You want to have that, and we put our short strikes here, and we put some protection. This is a very easy way to set up a strangle. You can do this here too. If we go out 45 days and we want to close at 20 days, that's why I love the swing model. We know these are two places where something can happen, and the lower band gives us confirmation. And basically, we're going to stay above that. And the risk trigger is that if we go above that, we should wake up, either adjust our short strangle, or we know something will happen, like here, it will go down again. So these are two very nice reference points, but I prefer to do these things systematically. So what would I do? I would say we open this here. This is our metrics, and this gives us days to expiration, which we can choose off. And these are the trading days, 31. And basically, if we want to be on the safe side, I said 45 plus X days, we could go here. This means the first reference point is the 50 or resistance and the put support. We can look these things up. This is in July. And high volatility level is important, but another thing which I want you to look at is the expected move, which is 12 points. We go back here and go to July. The first point I would take is the expected move, 15 points. So let's say this is 42. So plus 15 points. We are here, 42, 15 points, 5 points up, and another 10 points. We don't have anything in between. Maybe I could have chosen a more liquid option, but let's do it for the sake of it. We will go to 55. The same thing we will do on the downside. So if we take this off, it will be 25. The bid ask is a bit high, so I wouldn't choose that. But we found a stock which has basically high IV rank and percentile, and all the other metrics are for it. And if we chose something like Apple now, I couldn't really advise you to do it because most probably volatility won't help us, and we need Theta and Vega to work for us. So for the sake of it, let's choose this. Basically, because this is very high, we don't get anything here. I have to go. Let's stay here. Okay, this is better. You see, this is really wide. This is really wide. Here. We are a month down. Okay, so this would be for the next expiration, 42 days, 35 trading days. So this is a nice credit with a margin. So you make two, and risk-free. So in the end, this is really, really nice. IV is ramped up. So if we reduce that, we will be even closer to our break even. So if we stay here in range, this is something wonderful which can happen. So we go back to our MenthorQ. We chose this expiration here. And this is something we should keep in mind. We will talk about this later. So we have 50 and 30, and we have 12 points. So 50 and 30. If we want to be more correct, we subtracted that, and we saw the 30 and the 50. So this is what MenthorQ gives us. So this is a pretty nice wide range, and we know this will drop by roughly, will drop to 68 at some point. So this is what we can expect from our short strangle, roughly to happen. So if time passes, let's say we set it up today, we make one and lose two, which is also okay. It's very nice. It's not bad because this is a naked risk strategy. The thing is, yes, it is more dangerous if you don't have wings, but if this stock doesn't drop abruptly, okay, it can happen with any stock. That's why we can also do this in ETFs. But let's say if it doesn't drop abruptly, this is a strategy which we can very nicely adjust. And I will show you later how we can do that. So let me take a look at the watch. We still have a bit of time, so time left. So this is very easily set up just by using MenthorQ data. Because what happens? You have factored in the expected move. The expected move for June the 20th were 12 points. You deduct that from this, we end up at 30. And this year, maybe we should go a bit higher. We want to be safe, we could go here. Our credit is lowered, dramatically lowered, but we are in the safe zone. For people who set these things up traditionally, we would take a look at the delta. The delta is very low here, so we could be a bit more aggressive here. Normally we set up 16 deltas, 20 deltas. So delta is at 27, 28, 5. So this would be a delta setup strategy. Does this make sense? If you go and trade this mechanically, yes, it can make sense because you have not a fully delta neutral strategy here, but it's quite delta neutral. And delta hedging, this is something we talked about a bit, but we will talk more in some other point. But I prefer, especially by having MenthorQ data, to use these insights and have deltas in my mind. But the most important factors with this strategy is the passage of time and volatility as a second. Delta, yes, plays a role, but because we cannot really factor that in, we should only keep in mind that we do not, if we trade a short strangle, and I'm not talking about skewed strangles, we will do this and cover this in another part of the series. If we want to balance this, we should keep it quite delta balanced. So let's go back here. So another thing I like to look at, we went to 50 and we went to 30. So we look at the core resistance here. This is 50 and this is 30. So what I like to see here, because I want to take it off earlier than this, maybe take it off here. The core resistance is at 48 and 35. What does this give me? This gives me confirmation that something will happen at these reaction levels, and most probably move could stop there, which is good for my trade. Yes, maybe if we go up and it stops here, the call will be in negative territory, but theta will have worked for me. Plus the put I set up at 30 will already have lost a lot of value. So in the end, I should be at least in a smaller green. Otherwise, I can roll out of time. Looking at the last 5 minutes here today, excuse me, two other things I like to look at. Let's see where this is. Where is it? I like to take a look at my DEX chart, and I see here a 40 and a 45. So market makers sit on the other side. This is what is shown here. So we could see a drift to 45 and we could see a drift to 40. Again, this is a non-directional trade strategy. If I was to trade it directionally, I would try to see if we could go up here or we would be drawn back here. But this is something which just gives me an insight that we have, this is balanced out, and that's why I also chose X here, the US steel, because this is really nicely balanced. What does this mean? I want time passage and I want volatility to drop. These two factors I have. At least this is what the predictions are, that historic volatility is far higher than the implied volatility. So we'll have a drop, and time, no one can change time. No one, not even God, can change time, at least for us options traders. Maybe God could do that, but at least this is something we want to stay focused on, that time passage will not change. So this is a good thing. So in the last minutes, and we will deep dive into this strategy more next time. Things goes. Let's say the stock moves down, 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 moves down against you. At some point here, let's go back here. Let's keep volatility where it was. Drops here. You are here. This is this means if we are at 35, you will try to roll down again to take off a bit of the hood. Because we receive more credit, our break-even point is bigger. Let's go back to the original strategy and to decide when to roll. Do we decide when we go to 35? No. As long as it stays in between here and nothing terrible happens, and if I look at the term structures and other stuff, we will look at these next time for a deep dive, wouldn't do anything. Time passes. As long as you stay in between here, we're fine. Will I act if we are at 30? I will think about it. Maybe roll this a bit, but tons of trades over and over have shown that you should trust your levels and not to roll and to change anything too early. Only if radical things happen, maybe close the trade and take a loss. Be ready to do that. I would start noticing if something happens around my short strikes, and I would look at my break-even points, and only if my break-even points are breached, I will start rolling. If there's more than 21 days in my trade, then I would just roll the untested side. This would be our call here, for example. You can roll even until here to get a short straddle and try to stay in the circle. If I see that this doesn't help, I will roll out of time, and I will adjust the short strangle. So if I go to the next expiration, let me show this. This is here like 83. And if we go down here, this is a bit higher, but you understand the concept, we would receive more credit. I will readjust and I will go to the next expiration. So you can basically either close this trade and set up a new trade, receiving more credit, covering some of the loss and try to at least repair that, or you just can roll the one side. But I always close both of the side, except if really, let's say we have radically dropped here and there's no way the call is going to get into danger, but I would roll the put and open another short call with a different strike, again, delta somehow balanced and mainly set at the points where the call reaction zone is, which MenthorQ gives me, and I would get confirmation by the expected move. So this is everything said about short strangles in a very, very, very short way. We will cover this more because by having MenthorQ data and not using it, you have not using this on this kind of strategy is really would be sad. We will see how you can do it with an iron condor or with our iron flies, which are risk adjusted strategies, but you have everything you need here and you can set up directional trades. But if you want to get better as an options trader, if you want to advance your trading, you should really start thinking about trading non-directional too, if you don't just trade options as a day trader, which is really hard, except if you trade SPX. But with normal stocks, if you don't want to gamble and you want time on your side and volatility, all these things option offer. Otherwise, maybe futures are the better product. Then really, really harvest this data and do something. So Fabio, this is in brief. I think we used the half hour we had today as best as we could, and I hope one had fun. And let's see if there are any questions.
Yeah, I think no question, Dan. And so for those who want to learn more about our approach, our data, please come visit mentorq.com. And as always, Dan, this was awesome. Very great content. Thank you for sharing that. And yeah, there's going to be a lot of things going on this Friday. There's a lot of option expiring on SPX today. There's a large amount of gamma. So stay focused, guys, on the market, and see you guys again next week. And thank you again, Dan, for this. Hope you have a great weekend.
Thank you, Fabio. Good luck, everyone. And Hope you enjoyed it, and see you next week.
Bye, guys.